it's a sort of regulator's dream. It's sort of constructed, it's extremely complicated, and there are a lot of unintended consequences.
So, Mr. Day, can you tell me about the association you represent and a bit about its members?
Yes, I represent the International Commodities and Derivatives Association. The association is nearly 40 years old. It was started its origins come from the late 1970s. It originally started as the Commodities Industry Association, and it developed during the 1980s and 1990s at a time when new markets were emerging, and the international community wanted to launch and develop derivatives contracts and futures contracts. And so the association in the early part of its life was called the Swiss Futures and Options Association. And we changed our name a couple of years ago to reflect our membership. Our membership is international, so we're quite different from, for example, the Swiss Trading and Shipping Association.
So since 2008, there's been a real push for more regulations on commodity derivatives. How will this affect the investor and the market players?
Well, let's just rewind the tape a little bit. So from about 1992, the European Union or the European Commission had been focusing on financial markets regulation, and particularly in the period before the financial crisis, from about 2000 and the early 2000s to 2007, the Commission sort of rolled out in 2007 the Market Instruments Financial Directive. That's MiFID. And MiFID was a piece of regulation which was designed to increase transparency in markets, to encourage competition, to sort of create a more level playing field for players, to reduce systemic risk, and what's the other one? To increase investor protections. So that's what MiFID was about, and that was implemented, and I think most people thought that did increase some transparency and some competitiveness across the European Economic Area. MiFID II really was an implementation which came around after the financial crisis, and it was really designed to strengthen the sort of European-wide approach to high-frequency trading, to sort of look at the restrictions on high-frequency trading, and also to manage sort of abusive market practices. And in particular, as you'll remember, there was quite a big conversation about commodity price manipulation. Some of that was inspired at the time when I was working for the United Nations, where there was a big push to sort of deal with financial markets intervention in commodity markets and commodity price manipulation. But I think, as Jeff Sprecher, who is the president of the Intercontinental Exchange, ICE, said earlier this week at a meeting in the US, I mean, it's truly a terrible piece of regulation. It basically increases the scope for the scope of regulation to include commodities, to include OTC derivatives, over-the-counter derivatives, and also to deal with automated trading. And the problem is that it's a sort of regulator's dream. It's sort of constructed, it's extremely complicated, and there are a lot of unintended consequences. And the reason that we as an association are very interested in these unintended consequences is because they have a big effect on commodities derivatives players globally, and not even just commodities derivatives players, but because of the restrictions or the impositions placed on organised trading facilities, there is even an issue for brokers who might be trying to cross principal trades in commodities, and that could have a huge effect on liquidity, the ability of those commodities commodity brokers to be able to conduct their business. And I think that what the market generally thinks is that this regulation has been put together by people who know that they want to regulate but don't really understand necessarily how the market works. And the difficulty is that if you're a financial institution, you can't necessarily say that. If you're a big commodities trading firm, you can't necessarily say that. But we as an association think perhaps it's time that we should start to draw together some of these strands and talk about why this regulation doesn't work. Actually, probably the regulators themselves know that it doesn't work because they've had to postpone the implementation from the 1st of January 2017 to the 1st of January 2018. And now there are some market commentators who are even saying, well, perhaps we should just go straight to MiFID III because MiFID II is such a mess.
So you've been a trader and your association, they support global energy. How do you see the supply and demand of oil in the coming weeks and months?
The oil market seems to me to be sort of characterized by a sort of ceiling on prices driven by new supply. So what's happened over the last few years is there's been a consistent, if you like, even growing supply of crude around the planet, and demand really hasn't increased to reach that new supply. What's happened, and you know that new supply is the reason there's a ceiling is because you've got new sources of sort of marginal production, sort of shale or other sort of new marginal source of production. What's actually happened recently is that you start to see a reduction in inventories. There's while on the supply side there's the potential lifting of Iran sanctions, the lifting of the recent lifting of the US export ban. On the demand side, you're seeing sort of some positive outcomes now. In particular, you see US stocks this week have actually come down, and you see that Russia's talking about possibly reducing production. I can't give you a forecast for what would happen, but I mean, it would seem to me that it would be reasonable for oil to trade in a range of, let's say, $35 for Brent through to about $60. I don't know what we are this morning, probably about $50. Markets are generally more optimistic now than they were a little while ago. And you know, we have to wait to see what the OPEC meeting delivers at the end of November to sort of determine really whether we are in the start of a new trading range for oil.
So you have an event coming up, the Birkenstock event. What is that, and can you tell us why it's so important for the markets?
Yeah, the Birkenstock event takes place in Geneva. It's for the association. It's our annual flagship event. It's an event where CEOs from the major exchanges, from the major clearinghouses, the major players in derivatives community, it's where they come annually to talk about developments in the derivatives industry. Some of the things that I covered in the earlier part of your questions, Kais, like, you know, what's happening with regulation, where are we going with regulation, what's happening in the markets, where are CCPs going in their activities, what's generally happening to the world of commodities and derivatives. It's the 37th time we've run it. A good few hundred people will turn up at the Hotel President Wilson by the lake in Geneva. It's quite a lot of fun, even if there is quite a lot of regulatory chat going on. So that's Birkenstock, and is taking place, as I said, in Geneva by the lake on the 14th, 15th and 16th of November. So we hope that some of your viewers will come and participate.
I'm sure they will. Well, thank you, Dan, for coming in the studio. It's been a pleasure.
Thank you, Kais.
And thank you at home for watching. If you like this programme, do click on our channel for more broadcasts like this. Goodbye for now.